Hello, what is up, dudes and dudettes? This is Dudediligence here, and welcome back. Alright, since tax season is over, I got more time for video, so I'm gonna make a video about the FOMC meeting preview. So for those of you who don't know what FOMC meeting is, it's essentially a meeting that the Federal Reserve, aka the Fed, the Board of Governors of the Federal Reserve, in here it's not governor, but Chairman Powell will come out and do a sort of like a Q&A meeting with the press, and before or right at the day of the FOMC meeting, there's usually gonna be a huge spike on either commodity prices or on yield curves, right? So what does that mean is basically on May 3rd or 4th, the Fed is going to decide whether on this rotation or this month of the year, whether they are going to increase their interest rate or not. So from previously speaking, if we're looking at 2008 when or 15 or before 2008 when there's, or even in the 1970s, what happens is when stagflation started, where stationary inflation or transitory inflation becomes a sort of like a regular daily basis thing, the Fed got their hands tied and they want to sort of stop the acceleration of inflation. So what they do? They do consecutive rate hikes. What does consecutive rate hike means is on every single FOMC meetings, they increase the interest rate by 0.25%. Okay. So we anticipate that on May 3rd, the Fed is going to send out signals, and you can see it from bank statements coming out or prospects that coming out, Bank of America and all of the public banks, that you can see that the reserve, basically how it works is when the Federal Reserve, this is one of the reasons that the chairman of the Federal Reserve, and when you work in a bank that strictly communicate with the Federal Reserve, you're not supposed to alter your stock position very often. And before you even make that sort of kind of stock position move or bond position move, you're supposed to do a disclosure to the government, and the SEC will approve it. And it's done through a very intricate sort of like a consecutive thing where you can plan year by year by year by year, where a lot of times when the insiders are actually buying or selling stocks or buying or selling bonds, they actually planned it months or years ahead. I actually just learned this about a couple of weeks ago. So in this case, on May 3rd, I suspect, and a majority of us would suspect, that the Federal Reserve will increase its interest rate. So how would you benefit from they increase their interest rate? So when interest rate raises, usually the general equity market, which is the stock market, will come down. And when the general public believes that the Federal Reserve is going to increase the interest rate by the end or beginning of the month, what they will do is, starting before the beginning of that month or the end of that month, in this case somewhere around March 28th or 29th, which is last week's stock movement, what they will do is they will pile up on stocks that favors a bond yield going up, which basically is the inverse of bond, which is the inverse of bond prices, right? And then what would the entire market behave is, generally speaking, ahead towards the interest rate hike, the entire market would go down. So if we look at it, if we go look at the Nasdaqs, right, you will see that leading up towards today, the entire market is going down too. And a lot of you are gonna be like, you're just saying it afterwards, right? But in our Discord, I always warn everyone that maybe hold some SQQQ to just in case to hedge for your positions, because a lot of you hold a lot of long-term stocks. So just hold some SQQQ for some long-term hedging, because essentially when we reaches a point where people realize that, hey, like slow growth is coming, right? And then all of the earnings and all of the inflation data, even the second-hand car market data is showing that there might be a recession, and the recession is really close. It might even start by the end of this year. So the general market reacted really, really badly over the past weeks, and that's normal. And we're right at 12,300, which is 12,280, which is where, remember a month ago, about 2.5 months ago, we posted a video that we think the Nasdaq will probably go down to 12,228 or somewhere around there, but it will still have a a monumental run before it reaches that point, right? So it actually it fulfilled our prophecy literally, and it's right at this point. So how would you benefit yourself from the increasing of interest rate? Well, it's simple. You buy inverse bond ETFs. So in this case, we have TBX, we also have TBF right here, right? Like in our Discord, we started talking about this somewhere around March 1st and May 1st. I mean, March 1st and April 1st. You can actually go back and look at main channel, look at Patreon chat. You will see that on March 1st, somewhere around here, we said TBF, we are gonna basically use majority of our positions are all going to TBF, and people are really confused whether we're doing it. And then we explain that because we're making a major bond yield move, which back then it was somewhere around, well, March 1st is 1660. Right now it's 1951. So a $3 increase is pretty good. But if you buy options, I think what we did is we stack a bunch of options, 7, 18, 19. We bought it way ahead of time, right? And then, for all the account that I manage for other people, I actually bought some very interesting multi-leg strategy that helps you to harness around a 20% overall return if you made that decision to enter this trade. And for those of you who just blindly followed me and just bought a bunch of TBF, even 100 or 200 shares, 100 shares equals around $350 right up of now. If you bought the options, it's probably like, depending on, if you buy $350 of worth of options, you probably already have over 1,000. You probably already tripled your money at this point. And this is basically just one of those examples that I want to show you guys that no matter how bad the economy is, there's always going to be a way to understand where the economy is going. And another thing is, we also, if you guys are wondering what we've been doing over the past few weeks, except for work, because it's tax season and it's kind of busy, is we actually use simulation to figure out how big of an interest rate hike this year is going to be at. And then we're going to talk a little bit more about this in the next video. So we want to keep this video short, and essentially the result of that is TBF and TBX. We probably expected, especially TBF, we expected to exceed $20. So basically our strategy right now is to stack $20 call options on a longer period of time and hedge that with SQQQ and buy some TQQQ in case there's some reversal going on in the NASDAQ. And also in terms of oil and natural gas, we think it's at a point where if Russia decided to back out of Ukraine, or Russia decided to do something with their pipeline, the entire commodity market will crash in an instant. Because when Russia, if Russia's production chain go back to normal, that means 10% of the cumulative increase of all of these compounding daily is just gonna be boom, all back down, because the Russian government needs more cash when the SWIFT system basically embraced them again. So then, for example, the $25 the natural gas fund will evaporate at least $8 of its own value and go to 20, and it might even go down to 14-ish or something. But before Russia actually backs out, the fair value of this is somewhere around $20. So anything over $20 is danger zone right here. We've also been shorting a bunch of oil over time, because we think the spike is just way too much, and there's going to be a lot of government sanction going on with oil. And if you look at all of these, you will realize that, hey, like, it doesn't make sense. Like, if you look at 2020, and if you go back and if you look at 2020 or anything, like anything big velocity change, like over here, it's gonna have a very drawdown period of time. And then right now we're almost at the end of the drawdown period of time. Every time it goes down to about $4 or the equivalent level of $4, remember, this does a lot of reverse splits because of the popularity of shorting oil. But without like further increase the complexity of this ETF, because there's actually a lot of things that we can talk about in this ETF in terms of how to utilize it when oil is spiking, and you can make actually consistent return with this kind of stuff. Anyways, this is the preview for FOMC meeting, and hopefully you guys love it. And again, when interest rate increased, what means is oil price will actually go down, and the general bond yield will shift up, and then the bond price will goes down, and the general stock market will go down. See you guys on the upside. And again, we're not financial advisors. We do not give financial advice, and everything listed on the channel is for shits and giggles.